Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, April 3rd, 2023. In this video, I'm going to do something a little bit different. I'm going to cover essentially three different things. Now, these are three things that I've always covered, and always update from time to time, but I'm going to put them all together and really highlight the correlation among all these, and that is stocks or the stock market. We'll look at a couple of stock indexes. Interest rates via Treasury bonds. We'll look at high-grade bonds mainly, and then also currencies, which are the big ones: the U.S. dollar and the euro. It's really about the dollar, but the euro, as I'll show you, and I've often showed you, is pretty much an inverse correlation to the dollar, simply because it's the largest component in the dollar index by far, without even a close second. It's 57.6%, I believe, weighting. The yen's only like 23 or something like that. Everything else does not move the needle in the dollar index. So really, dollar goes up, euro goes down. Now the thing is too, there's by doing that, since what I'm going to show you here, and I've talked about it repeatedly since the bear market started, there has been a very, very tight, unmistakable correlation between the price of bonds, stocks, and the euro. So we're going to look at that. I'm going to show you the outlook for each because it weighs very heavy into my analysis, and these are the things I'm watching. So I'm not just going to show you the correlation, I'm going to show you the levels to watch that will start to change things, in other words, change my outlook. As of now, it remains the same. Let me just recap the markets. We closed down, first down day in a little while. We've had a few down days, a few up days on the NASDAQ 100. This is a 60-minute chart, so we're only looking at the 60-minute candles, but you can see that we did close down by about a quarter point, and despite the rally, I know how this works. Those bullish or long will say, well, boy, they gobbled that dip up with veracity, and they did buy a good part of it, but not, at the end of the day, you close red or you close green or you close unchanged. Today was a red day, and even more of a down day in the equal weighted, down about almost 0.5% in the equal weighted NASDAQ 100, which you can see broke a comparable uptrend line right there. So just wanted to say the sell signal is still very much intact. A breakdown's a breakdown. Nothing goes down forever. That's a kickback rally. If anything changes from a technical perspective, or my little spidey sense starts to tingle, and I think it's time to pull the plug on. For me, I'm telling you what I'm doing on my shorts, and I'll let you know. But as of now, I still think we'll work our way down here. Next sell signal, as I said this morning, or really big level to watch, which would be the next objective short entry or sell signal would be a solid failure back below that key 313 level. Yeah, these major reaction highs. Boom. Fed, that's Fed day right there. There's the Fed day range. And remember, we had one breakdown to the downside that proved to be a whipsaw, and the million-dollar question, is this the real deal or not? And we'll see. Like I said, the momentum certainly in the very near term is to the upside, but we broke that uptrend line today, and so that's that. And the positive divergence is, again, way heavy. So I'm not going to go into everything I did in the earlier video. I showed you the divergences on the daily chart, on the 60-minute charts. I showed you the long-term trend lines. Let's just look at correlations here. Okay, two things on these correlations, and this is very important. Certain things have immutable correlations, such as gold in the U.S., or I should say interest rates and bonds. That's an immutable one. There's no variation. It's a direct inverse correlation when interest rates go down. And again, I'm speaking of government bonds because the quality issue isn't in there. When you get into junk bonds, it changes things, and even corporate lower grade, medium, and lower grade corporate bonds, because then you have the default risk that can increase and does increase in times of market stress and all that. But in government bonds, they're going to pay them back no matter what. Government's not going to, they'll just print money if they need to make whole their obligations. So let's not get in the whole massive debt, deficits we're running and all that. At the end of the day, they'll devalue the bonds by printing more currency, tactical or strategic devaluation, but that's neither here nor there. I'm kind of getting off sidebar. Government bonds, you're always going to get your principal and interest back, come hell or high water. And so the only variable in there that causes the prices to go up and down are interest rates. So that one's immutable. The correlations, which are very gold in the U.S. dollar, have a very strong correlation. It's really an inverse correlation. One goes up, the other goes down. And as I've said many times, that's simply a function of gold, at least the gold you and I trade, or not all of you, some of you are over the pond, maybe trade in euros or other stuff, but the gold here in the US and the gold ETF, GDX, and everything else trade in US dollar, priced in US dollars. So therefore, when the dollar drops, if the dollar goes down, let's say 10%, it's going to take more dollars to buy an ounce of gold. So when you freeze supply and demand, which is the other variable there, supply and demand can influence that correlation. But I'm going to show it to you here anyways on the chart. But it's again. So what I'm going to do is I pulled up the euro. You could do the same thing if UDN. It's going to look exactly the same. Let me just show you what we're looking at. The white candlesticks are the euro, which again is my proxy for the inverse dollar, or just shows how the market's been trading. And if you want, you can very much do the same thing with UDN. That's the inverse US dollar index. And again, they're going to look identical. So whichever one you want to go with, I'm just going to, for the sake of the video, because we're going to analyze the euro charts in a minute here. All right. Now, the period I'm talking about primarily, especially with the stock market, this correlation is not so much immutable, unchanged over time. It can be an on and off thing. But what I'm focused on and what I'm going off here is the fact that we are still in, and by my belief, from my analysis, in a bear market. And as such, we're going to pay attention to the correlations that have been in place. Remember, the NASDAQ 100 topped right here, and well, actually it was mid-November. And then everything else, the S&P, most of the other indexes topped there. And it was basically a double top in the NASDAQ. The NASDAQ's in purple, by the way, QQQ. So what we have is a very clear, you can see the correlation. In that correlation, one going up when the other's going down. And please know this, it's not a day-to-day, minute-to-minute, second-to-second correlation. It's the trends. You want to look at when they're moving up, look at the peaks. For example, there's when the NASDAQ peaked. And I'm sorry, the NASDAQ was right here in purple, and that's you can see roughly the euro peaked, and that means the dollar bottomed, and remember the dollar was going up. And then you can see there was a major trough. Again, QQQ's in purple, so we're looking at the stock market. It's kind of a chicken and the egg thing. Sometimes one will peak right before the others, but they're just almost perfectly correlated. There was the bottom in the euro and white candlesticks. They both rallied. Again, do not, when you're looking at correlations, you're two different complete asset classes. Or completely different, excuse me, get that right. Two completely different asset classes. So they're not moving up and down in the same percentage terms. And far from it. Currencies move very little. And that's why they're measured, the moves are measured in pips instead of percentages like the stock market. And so what you can see is just again, look at the troughs and the rallies. They both rally, they both go down. And here you had a bottom in the Qs first, the NASDAQ 100. And I could put the S&P up here and you'd see something similar. They're going to move roughly together. There's a peak. And then they bottom. So you can see right here, the back in late September, the euro bottomed. That means the dollar topped and started moving up, and then the market bottomed just right after it, right there in the middle of October, right? And started moving up as well. You can see there was a little period of, well, not so much, because that you can see that was actually going down. It was again, the correlations there. There's a major top right there in the euro, major bottom in the dollar, also major top, big correction in the NASDAQ. Okay, so you can see the correlation. Let me just show it to you in gold as well. Turn this on, edit chart properties. We were looking at QQQ in purple there, so I'll put up gold. And you can see too, especially once this bear market became official, which again, if you count the S&P 500, which most people probably go down in history, that's the beginning of it. You can see there the correlation as well. You can see both moving down right there to that point, a perfect inflection point. Both start going up. There was a little disconnect there, but for the most part, again, you can see the lines overlaying almost perfectly. Even now, you can see gold sort of outperforming its usual, running up a little stronger, but it is running up along with the euro, meaning dollar down. So Again, the takeaways here are I'm showing you an unmistakable correlation that has been the correlation de jour. And again, there may be a time, and we're going to get to interest rates too, which let me do that now, and show you bonds. So, okay, there's gold, the stock market, and now let's just switch over and look at bonds. We're going to use the 10-year. There's all different types. Again, I'm using Treasury bonds in particular for the reasons I stated. And that's what people are usually looking at when they're talking about interest rates. And again, an unmistakable correlation. It's right there in front of you, and you can see what's going on. So now what we're going to do is analyze each of the three and take a look there. But you can see lately you're seeing, again, the correlation is still very, very much intact. They're not going to overlap. And you saw a little bit, you can see from day to day, week to week, you see one of the two walk away. You can see a little divergence, and that's usually too when you get your inflection points. In this case, it was the euro going up, and you saw a little divergence between it there on IEF, the 10-year Treasury bond. And remember, these are the bond prices, not the yields, because it's the prices that have been moving in together. So we're going to look at all these real quick. It won't be a super long video, and the takeaway will be, again, I kind of threw out the conditional that some of these are on-off relationships. In fact, this one, if nothing else, here, let me show you. Let me take away. All right, we have FXE in white. Let me put in SPY. So now you're looking at the S&P 500 in white, and you're looking at the 10-year Treasury bond in green, and you can see this very, very strong correlation. They both peak back here. That's when the S&P peaked. There's your top, and since then they were both falling, then they both rally, and that, guys, is very unusual. The correlation between gold and the dollar, that's and between the currencies, of course, that one is age old, but the correlation between the stock market and Treasury bonds, now this kind of turned the world upside down, and this is a result, in my opinion, of years of excessive intervention in the financial markets and artificial manipulation of interest rates, holding them excessively low for too long, doing the bond quantitative easing and then quantitative tightening. Either way, whatever your reasons are, you can't argue that it used to be, you'd see, and that's where the old 60-40 model blew up, where prudent money management says, on average, everyone's different, you'd have 60% in a growth model, 60% of your funds in hedge funds use this model or used to, into stocks, and then 40% into bonds. And forever and a day, going back for 100 years or so, when stocks would correct, when you'd have stock market corrections, bonds would tend to rally as a flight to safety. And so that model helped really mitigate risk, but that model blew up and stopped working in a very bad way when this bear market started. Now look, all things are rising. It's that you can see the correlation is still there. Lately we've been rallying in the S&P 500, and so have Treasury bonds, right? They were both falling right here. They were rising here. And now we're going to examine those, and we'll wrap this video up. And so the takeaway is, you guys know my thoughts on the market. If and when it changes, I will let you know. I'll convey my thoughts, but I am going to show you the outlook, make a case for each of these. And the reason is, there are times, and a good example is a few weeks ago, I started to, I'm not going to call it a backpedaling, just kind of step back on my longer term outlook for gold. I've been adamantly longer term bullish on gold for a couple of years now, saying we're in a bull market, even in the correction. So it looks time to short it, get out, but we'll eventually go to new highs, and that still may be the case. However, what I had said a couple of weeks ago is what I was looking at in the charts with the currencies primarily, because that currency is a age-old one with the between the dollar and gold, and looking at that, my outlook for the stock market and gold didn't mesh, because again, you've seen again, I'm going to use the euro or the inverse dollar. They've all been, gold has been falling typically with a rising dollar, or with the rising dollar, and so has the stock market and Treasury bonds. And so it would take a disconnect of these correlations to have this play out where gold goes up, stock market goes down, and the dollar goes up as well with the euro going down. Here, let me show you the charts. I know that's kind of start to confuse myself because I've got three different, completely different asset classes, and to make it a little more confusing, of course, the dollar is inverse to the stock market and the gold, so then I'm using the euro. Okay, can't make it any more complicated than that, can we? All right, let's just look at each of them on their own technicals. Let's just go to a 60-minute chart. Let's start with, well, okay, I'm not going to do the equity markets because you know that. We've got the divergence. Really, I'm looking at the big tech. I think that one is by far the biggest bang for your buck on the short side. I think the rally in tech, which has very largely driven the market off the lows in January and even on this recent leg up, I think for many reasons, both fundamentally and technically, it's unfounded and gotten ahead of itself, and that's where I think we'll see the best when we get the next pullback, whether it started today with that breakdown or whether it comes 3 weeks from now. I think there'll be more downside in QQQ, but than SPY. But let's look at Treasury bonds. And in doing that, we can look at the rates or the bonds themselves. And I won't go through each and every one because you can go through, you've got ETFs for the 3 to 5 year bond, and that's SHY, I think it is, or is that in the 1 to 3 year? And then you have IEI, 3 to 7 years. So you can play around with all these different time frames you want. We'll focus largely on the 10-year IEF, and you can see right here. You have, this is a 60-minute chart. You had a divergent low here, pointing out the time. In fact, I laid out 3 targets. We hit the second, came close. We hit the first right here, came close to the second. Still could get there, but I'm showing you near-term outlook. So since then, we've been working our way up at a rally, and just like the positive divergence and then the trend line break was a catalyst for this move up, we put in a divergent high, we had a correction. We put in no divergent low, but we had another leg up and a marginal new high with divergence and even bigger correction. Then we ended that correction with a divergent low. We've rallied. We recently put in a divergent high. And we had a correction, but this correction so far is atypical. It's a lot smaller than these previous ones. So, and I'm going to show you some other things that say we could go down. Now, if we keep going up and we go on to hit these targets and we burn through, if that divergence is all we're going to get, that may start to change things, and that's change things for me. That's a takeaway from this video. If at some point I can no longer make a case, as I can right now, I can make a case for a pullback in bonds, which I did last week. I told you just about not even a week ago, hey, I pointed all this out, this divergence here. And if I can't make a case for a pullback in the euro, it's not going to happen in gold. The GDX trade won't play out. I'll get to that. And the stock market may continue to rally. So there's the 10-year. We will look at the 5-year real quick. 5-year, same thing, divergent high. There was a divergent high right there. You can't see because the line's right. I had a line on it, but there's our divergence right there. And it looks almost identical. Divergent low, divergent high, divergent high, divergent high. And the million-dollar question, is that it? Is that all we're going to get? That divergence is played out, but is that just a first leg down? Usually corrections don't end in a single wave. It's possible. Probably get another leg down. And then we'll look at TLT for fun. TLT, really no divergence. The 30-year bond, right now, everyone's been trading, and I don't blame them, hyper-focused on the shorter end of the yield curve because you're getting a lot of bang for your buck until recently, until the Fed meeting. The Fed fund futures have trickled off the shorter-term rates. Nobody who wants to lock their money up right now for 30 years at these abysmally low rates. Either way, all I can tell you is there's a pretty good resistance right there on TLT at about 109. Or so. Now let's look at the rates themselves. Let's go to TNX. Again, this is the yield. So now what I've done, we're looking at the price of bonds upside down. As I said before, there is no variation to this relationship. When yields go up, bonds go down. I'm talking about government bond yields. The price of government bonds go down, and vice versa. So all I can tell you is we had a divergent high there. We had the primary trend line. It broke down, and then we back tested for a while. Back test, back test, back test below. Not a lot of times. Once in a while, I'll see this. I'll see a breakdown, and then it's what I call a high-level back test. You usually form a little it's a parallel trend line quite often, or a sloping, some type of wedge type line, and then it's that. After back testing for a while, that secondary trend line breaks down, and that's the top. And so that brought yields down, and then, like everything, it hit support, had positive divergence, and you got a rally. Then it came down again, positive divergence, we rallied even bigger. And now we've come down again, positive divergence, we've rallied, but nothing remotely close to even these last two, and they were relatively small rallies. So this, again, shows you just like the stock market has negative divergence, and you go back in time, you almost always see this positive divergence on the yields. Because remember, at the same time, you're going to have negative divergence. When you have positive divergence on TNX, you're going to have negative divergence on the 10-year bond, whether it's the futures, ZN, or your 10-year Treasury bond futures, Zebra in November, or you trade IEF as the ETF. So there it is. So this tells me that's likely the first leg up, maybe some more downside. And let's look at a little bit longer term, bigger picture. This is even more important. I always put a bigger weighting on the longer term time frames. Busy chart, what I'll do is I'll turn off all the lines for you and just draw it. What most important, you have this spike low. That was the all-time low right there, and Fed gone wild back there when COVID hit. Coming out with the all-out nuclear option, and you've got a nice clean uptrend line. You had divergence at this point. You did have some divergence, relatively small, and that brought us back to the trend line. And so this is it. This would be, if we break this trend line, and it's anything more than a whipsaw that gets us back above there, whether it's a breakdown or back test, if we start heading lower, that should be bullish for equities. That's going to mean lower rates, but I'm putting should be in quotations here, because we are heading into recession, and typically that brings interest rates down. All I'm trying to get at is be careful that some of these correlations may not continue forever, and that's why I'm doing this video. If I start to see a disconnect, I'm going to recognize that, point that out. But as of now, again, you can sit there all day long and predict when it's going to end, but right now it hasn't. There's no evidence in the chart that it's ended. So what I'm telling you definitively is that TNX, the 10-year, is at very good. It's at a long-term trend line, the bull market trend line off the COVID lows, bull market for rates, which is a bear market for bonds. That was the all-time low, or historic, more in my lifetime, or anybody even older than me listening to this video has never seen the rates that low, and they've been moving up steadily from there, and they're at trendline support. So guys, if this happens, you have positive divergence on the 60-minute chart, and you have the 10-year yield at trendline, major trendline support, which says TA 101 says you buy support, or you can wait for a break below and short it, which again, you'll be going long Treasury bonds if you break down here. Otherwise, if this happens, Treasury bonds are going to drop. And if the same correlation that has existed since the stock market topped here, back here in beginning of 2022, you can see that that's what's most likely going to happen, is that right, rates start going back up, and you can see the recent disconnect. This is what I was talking about here. There's that recent disconnect, and usually there's a mean reversion when that correlation disconnects for a while. Wait, what are we looking at here? Oh no, I'm sorry, it's not an inverse. There it is. There's IEF. There's the 10-year. So again, if the IEF, if the 10-year starts to go down from here, as the charts indicate to me, especially if the yield bounces off that trend line, then stock market's going to go down just like it did here. There's 10-year started dropping, stock market followed. 10-year started dropping here, stock market was going down. 10-year rallied from here, stock market was going up. 10-year went down from there, stock market went down from there into the lows, right? Okay, there it is. We can look at it with a couple others. Like I said, it'll be the same thing. We can put on IEI. You're just looking at different maturities, but the same thing. The rates are pretty strong there. And let me just go to the 60-minute charts of each one. So IEI negative divergence, as I showed you there. TLT, we didn't have the divergence, but we are at the long-term trend. And then finally, let me go to the longest term that I go to. I've covered this quite a bit, and I showed you TYX. Showed you this earlier today. Zoom it out, turn off all the lines, because we can just draw a single simple trend line from the very highs in interest rates, peak back in early 80s, 81, 1980, 81. There's the breakout right there. And so if this happens, that means yields down. It means bonds are going to rally. If the correlation continues, well, if yields go down, bonds will rally, and if the correlation continues, then that's going to call for higher stock prices, unless the correlation disconnects. And I have showed you long-term charts of this, that over time there is an unmistakable correlation, inverse correlation between interest rates and the stock market, because falling rates typically are good for economic growth. But again, I have to caution this. Everything is topsy-turvy right now, because we're uncharted waters as far as, usually you had the Fed hiking. Usually the Fed, starts hiking. And they thought, well, this time around they waited too long. They hiked too fast, and we've already seen every recession indicator fire. Yet by most metrics, the economy still appears on decent footing. Although I have been watching, everyone I'm watching is starting to roll over lately, most of them. So where I'm going is we could see rates go down, which means bonds rally and the stock market go up. That would be the old relationship. If the stock market goes down and bonds rally, that was the old relationship. Bonds could catch a flight to safety bid. We could also see interest rates go down because of recessionary fears. There are those cross currents. I've laid out the charts showing you, commodities and that whole the negative feedback loop. I know it gets confusing. There's a lot there if you're watching all that, but the point of this video is we're watching three things really, or I am. Interest rates, and that's via, the most accurate gauge are these Treasury bonds. We're watching stock prices, which I don't know how to draw that. We'll just draw a little chart like that. And we're watching gold. So let me get to gold and GDX for you, because I know I just gave you a sell signal on that the other day. So this is gold on the daily chart. Let me turn off all the correlations, edit chart properties, take away the S&P 500. And, like I said, we have negative divergence right here. And this reminds me, guys, there's one more chart I wanted to show you. Yes, I have something definitely to show you. But you can see the negative divergence there on the daily chart, just like on the NASDAQ 100. I have that divergence right now. And let me just show you gold and how the stock market, let's just look at that correlation here. Put up S&P 500 on top of that. So you can see again, it's weird times, because the flight to safety instruments, which usually go up when the stock market goes down, they've been acting, trading positively quarterly. Look at gold. Look at gold since the bear market started. S&P 500's in purple, and gold and the stock market have been trading in kind. But gold, just like the stock market, they have negative divergence. So that's why, recently kind of said, let me step back here, because either these correlations are going to disconnect and maybe revert back to normal, or if they continue, this is telling me gold's likely to go down, the stock market's likely to go down, and bonds are likely to go down based on the charts right now. And that's, again, assuming that the correlations of all three continue. Oof, I hate when that happens. So I went to pause to go to the next slide, and I realized I've been covering this, and it was not recording. For the life of me, maybe I'll get on board with that GPT chat thing, or find a programmer that can do it. And write a program for this screen recording software that tells you when you sometimes you click the little pause button and you move on, collect your thoughts, move on to the next segment. Anyways, I don't know where it stopped recording, so I have to go back a little bit here. I'm going to be redundant, but I was showing you on GDX today. I started with Euro. I'll just kind of go backwards into that. You had the 60-minute bearish rising wedge pattern I highlighted recently. Yesterday you had a sell signal via breakdown, and today you went slightly within the wedge, but all that did is two things. Number one, it just tested that previous reaction high, which you got so close it was almost like a magnet. When you get really close to resistance level, you tend to go hit it. So you checked that, got below it. I'm not going to say a hard rejection, but you did pull off it, and you also fell back below and closed below the 60-minute wedge. So effectively that's just a breakdown and a back test. And all this marginal new high did today after yesterday's breakdown is extended the divergence. So from a technical perspective, especially because it's just now a breakdown, a back test, and the divergence is still intact, nothing has changed on my outlook. I still maintain these targets. If we start to go up a lot more, take out these divergences, yeah, things start to change. You take out a previous reaction high. But let me go to the Euro now, and I think this is the only other part I missed. 60-minute chart of EUR USD. You had the yesterday after the sell signal came in GDX, the breakdown. I followed up, believe under that post, showing you we had a confirming breakdown or a subsequent breakdown in the Euro right there. And all that did today is make a back test. And just like gold, or GDX, if it wants to pop up and make a marginal new high, you have big resistance right overhead here. Let me put the line there. You can see now. Let me just mark it for you. You have 1, 2, 3, 4, 5, 6, and they're really 7 highs. So that's a pretty big level. And so as long as we stay relatively close, and they're not much above here, because if you do that, then you start to burn through the divergence. So I just wanted to reiterate that the short on GDX, and as of now, I don't see any reason to change it. Somebody asked that question, hey, any change in your outlook? No. If it starts going up here, divergence is gone, and I can't make the case anymore for a decent pullback, then yeah, things may change, and I'll have to throw that one away. And I'm going to wrap the video up here. I'm going to loop back to TNX, because again, that is, if you're only going to watch one bond, I like to watch them all, one maturity on the Treasury bonds, it would be the 10-year. That's probably has the biggest impact on the economy, the stock market, mortgages, everything else. All right, so I already showed you that we are at uptrend line support. I went over that earlier. And that's it. Support until unless broken. You had the 200-day moving averages and a bear trend, you're below them, and then in a bull trend you recover them, and you're testing those as well. So you have 200-day support. You also have, which I wanted to show you, let me turn my lines back on, you also have positive, aka bullish divergence right here. You can see we're making lower lows as I zoom in, take this line right here. As you come to support, you have positive divergence right there on both the RSI and PPO, right? And let me squish these down a little bit and then show you the PPO histogram. This positive divergence, we're about to get a bullish crossover. Bullish crossovers are when the PPO signal line, which is the white line, crosses that orange line, the PPO line, and the histogram just gives you a visual representation of when they cross. So let's just take a look at that real quick, and I will wrap the video up. So there was a bearish cross right there. I'm pulling the line up, and you got a bear trend, right? You can see these hills, they're not always equal size, but everything works. Trend, you have uptrend, downtrend. So right here you had a green hill, bull trend, right? Bear trend, bearish cross, bear trend. You can go back and do this yourself. Bull trend, it captured that bull trend there. And so what I can show you is the PPO is poised to cross over. There's no guarantee. Sometimes you run out. Here's a good example. It's right here. You look like we're just about to do it. You're one day away, but it got rejected. It kept that bear trend going, and that is possible. But I'm going to watch for this. We get the crossover. It's usually, again, you go back and look when the green hills, when you cross from green to red, that it's usually the start of an uptrend, and you can see it there. So that would support the case. Look, we're either going to break down or not. If we break down and it's more than just a whipsaw, you're going to keep this. It's going to look, this hill is going to look like that. But usually, there's another example where it looked like you were going to cross, and the histogram stayed red. But if it does cross, you're going to confirm this divergence, and this is pretty big positive divergence. So what I'm looking at here to wrap this video up is a very good chance. I favor a pretty significant rise in interest rates if this happens. Bonds will go down in price, and due to the correlations we've seen since this bear market started, the stock market should go down in price as well. And gold, although it's been catching a bid lately with the flight to safety bid, especially with the banking sector, the correlations would say that gold is probably going to go down as well. And like I already mentioned, Bitcoin's also correlated, Bitcoin and Ethereum, to the stock market. And if I'm wrong, then these are the things that are going to tell me I'm wrong. Yields break down, we continue lower, the divergences are gone, and I can no longer make the case for a rally or reversal in Treasury yields and Treasury bonds and gold and everything else. Then that's where I start to change my outlook and my positioning. Oh, and then finally, I didn't even point it out here, but you also had a pretty nice downtrend line here off the highs. And just like the stock market, you had a breakout recently and then a back test of it. If it fails, and that whole thing there is a whipsaw. It's a pretty decent 1, 2, 3, 4 breakout, 5, numerous reactions. So again, all this here is going to determine, I think, where the markets are going, and certainly where treasuries are going. All right, I will wrap it up here. Those are the things I'm watching, and again, they're not going to be single one-day events from here, but how they unfold this week and going into next week could be very telling for the market. This has been Randy Finney with Right Side of the Chart.